People think the 2008 crisis started because borrowers were too broke and banks got reckless. No, not even close. What if I told you the real cause started with a psychological lie? So simple, you could print it on a billboard. And it sounds reasonable until you realize it's lethal. Why worry if home prices never go down? It sounds like financial advice. But really, it was a curse. Because the moment all of America believed that sentence, the 2008 crash stopped being an accident. It became destiny. So here's the real question. How did a modern financial system build a machine that turns terrible loans into safe assets and then blows up the entire global economy? In the next few minutes, you're going to understand 3 mechanisms that made 2008 inevitable, 3 warning signs every bubble leaves behind, and why the next crisis won't look like 2008. But it will absolutely rhyme. All right, let's rewind to the early 2000s. The dot-com bubble had just popped, September 11th had just hit, and America was shaken while Wall Street twitched like it had been hit with a taser. And when the economy looks scary, the Federal Reserve does what it always does. It slashes interest rates lower and lower until they're practically zero. Money becomes cheap, borrowing becomes easy. And suddenly, America's favorite national pastime isn't baseball anymore. It's buying houses. Buying houses like you're at Costco. You see something nice, you throw it in the cart. Sounds ridiculous? Wait, we're just getting started. A guy walks into a bank and says, "Hi, I want to buy a house." The banker asks, "How much do you make?" He says, $20,000 a year. And the banker smiles like a car salesman and goes, "Perfect. You're approved for $500,000. The guy freezes. "Wait, how am I supposed to pay that back?" The banker shrugs. "Don't worry. This is a special loan. It's called a ninja loan. Ninja, no income. No job. No assets. No problem." And right there, the moment lending stopped being about getting paid back and became about selling the loan to somebody else, that's when the machine officially gets switched on. America enters a new era, a full-on housing fever. People aren't buying homes to live in anymore. They're buying homes to flip. Buy today, sell next month, make tens of thousands. It stopped sounding like investing and started sounding like a second job with insane overtime pay. A kindergarten teacher tells you, "By day, I teach kids how to spell. By night, I go house hunting. I just bought my 3rd house." You blink, "Wait, where do you even live?" And she says, completely calm, "I don't know. Who cares? As long as prices go up, and once the entire country starts thinking like that teacher, real estate stops being a place to live." It becomes a game where the first ones in win. Here's the craziest part. In some places, home prices were climbing 1 to 2% every month. In some neighborhoods, they jumped 10 to 20% in just a few months. Some people bought today, and 6 months later sold it again, making hundreds of thousands like they hit the lottery. So the mindset became simple. If I don't buy now, next month, it'll be even more expensive. And just like that, a home stopped being a home. It became a national scratch-off ticket. And America started scratching. And the banks, they didn't even act like banks anymore. They acted like those guys who call you to sell an iPhone on payment plans. A mortgage broker calls and goes, "Hey, have you bought a house yet? If you don't buy now, you're going to miss your chance." You say, "But I don't have a down payment." He laughs. "Oh, that's nothing. 0% down. You don't need to put in a single dollar." You hesitate. "Okay, but what about the interest rate?" He winks. "Relax. The first month is cheap. The first few years are interest only. We'll deal with the rest later." Translation? Sign now, panic later. And here's warning sign number 1, to one that every bubble in history has in common. When an asset starts rising too fast, people stop asking, "Is this actually worth what it costs?" Instead, they ask one question only. "How much can I flip it for next month?" And the moment the question shifts from value to escape, that's the moment the bubble starts inflating like a balloon. But there was still one more thing that made everything 10 times more dangerous. You'd think banks would be terrified of risk because if you default, they lose money, right? Wrong, because the banks weren't keeping these loans. They were selling them immediately. They took your mortgage, wrapped it into a product, and sold it straight to Wall Street. And from that moment on, the bank stopped caring whether you could repay the loan. They only cared about one thing. How many more loans can we push out? And that's when Wall Street walks in armed with a genius idea. Take trash, wrap it up, and sell it like gold. Because when Wall Street looked at those mortgages, they didn't see risk. They didn't see broke borrowers. They didn't see reckless lenders. No, they saw one thing: raw material. It's like having a dumpster and saying, don't worry. If we package it right, it becomes a luxury product. And Wall Street was very, very good at packaging. So they took thousands of home loans, mashed them together, and boxed them into a brand new product with a very fancy name: mortgage-backed securities, MBS, now with 90% more deception. So what is an MBS really? Here's the pretty version. You pay your mortgage every month, I collect all those payments, sell them to someone else, and take a fee. Here's the real version. You pay the debt, Wall Street sells the debt, someone else collects the interest, and everybody smiles. At least until they realize they're smiling inside a burning house. But wait, who would buy something called a bundle of debt? Don't worry. Wall Street didn't need to make it safer. They only needed to make it look safe. And the way they did it was painfully human. They took these MBS bundles to the credit rating agencies, like they were taking a product to get a stamp of approval. And they asked casually, hey, this is good, right? Give us the premium label. And if the agency nodded, Wall Street slapped 3 letters on it: AAA. Done. In that instant, a pile of loans from people who probably couldn't repay suddenly became super safe assets. Like the market was saying, don't read it, don't question it, it has the stamp, so just buy it. And here's the funniest and scariest part. AAA back then was like a verified check mark on social media. You could say anything as long as you had the check mark. Except the check mark on social media makes you trust the wrong person. Wall Street's check mark made the entire world trust the wrong system. And here comes the twist. You thought the rating agencies were neutral referees? No, they were paid by the very banks selling these products. To put it simply, it's like playing soccer, and the referee turns around and says, whichever team pays me more gets better calls. So even the riskiest debt bundles kept getting AAA ratings, and the entire world bought them like they were gold. But Wall Street still wasn't satisfied. They looked at MBS and thought, this is great, but can we make it even more complicated? So they created the CDO. A CDO was basically taking multiple debt bundles, stacking them into layers. The bottom layer was the nastiest. The top layer looked clean, and then they sold the top layer like this. Relax, you're buying the good part. And here's warning sign number 2, something you should remember for the rest of your life. Complexity doesn't make something safer. Complexity only makes it harder to expose. And at that moment, the entire system started believing it had become unstoppable. And while the world was buying AAA stamped products like they were gold, a small group of people did something unbelievably weird. They read the fine print. They looked inside the ninja loans. They looked at the cheap teaser rates that would explode later. They looked at borrower incomes. And they smelled something familiar. The smell of a bubble about to burst. And they asked a question that sounded like a joke at the time. What if home prices actually fall? And then they asked something even more insane. If that happens, why don't we bet against it? Which meant they wanted to short it. They didn't want to buy homes. They didn't want to buy mortgage bonds. They didn't want to join the party at all. They wanted to make money when the party burned down. But here's the problem. Back then, you couldn't just short housing like clicking a button. There was no product, no easy trade, no big red switch labeled "bet it collapses." So this small group of skeptics did something completely unhinged. They walked straight into Wall Street and said calmly, look, these loans are trash. We want to bet against them. Build us something that pays us. If this whole thing explodes, Wall Street laughed, You want to bet the housing market collapses. That's adorable. But then, they notice something far more attractive than the warning. Monthly fees, steady payments, reliable cash flow, basically a money printer for Wall Street as long as the bubble didn't pop. So Wall Street shrugged and said, "Fine, you want insurance? We'll sell it." And that's when they went into the kitchen and cooked up the thing that would eventually help blow up the global economy. Credit default swaps, CDs. A CDS was basically an insurance contract. You pay a monthly premium, like car insurance. And if the mortgage bond goes bad, you get paid. And if it stopped right there, honestly, it would have just been a life jacket. But Wall Street added one sentence, one line, that turned CDS from insurance into something weirdly dangerous. Oh, and by the way, you don't have to own the bond to buy the insurance. In other words, you could buy fire insurance on your neighbor's house. You don't live there. You didn't build it. You have nothing to do with it. But if their house burns down, you collect the payout, and here's where it gets truly insane. It wasn't just one person buying this insurance. The whole neighborhood bought it. Then, the whole city. One single mortgage could be insured 10 times, 20 times, even more. So when that mortgage failed, it didn't fail once. It exploded, like dominoes falling in a chain reaction. And for a while, the system still looked perfect. Home prices went up, borrowers kept paying. CDS was just steady monthly fees. Wall Street was eating like it was an all-you-can-eat buffet. Everyone thought they were brilliant. Everyone kept repeating the same spell. Home prices never fall. Until 2006. Interest rates started climbing. Borrowers started falling behind. Houses started sitting on the market, untouched, like a sale nobody wanted. And the thing that was impossible started happening anyway. Home prices stalled, and then they dropped. And by 2007, the Jenga tower started to wobble. At first, it was just quiet cracks nobody wanted to hear. A missed payment in Nevada, an empty condo in Florida that wouldn't sell, a family quietly handing back the keys and disappearing. But what actually rocked the system wasn't a few homes. It was what happened right after. Adjustable rate mortgages started resetting. Last month you could pay. This month, you couldn't. And when millions of people started defaulting at the same time, those AAA assets that were supposedly bulletproof were exposed for what they really were. Not gold, but garbage sprayed with expensive perfume. Wall Street stared at the price charts and panicked. Wait, we can't sell this anymore. No one's buying. And if we can't sell it, we're holding a bomb. By the summer of 2007, Bear Stearns started bleeding out. 2 of their hedge funds collapsed. Not the kind of collapse you casually read about in the news. The kind where phones won't stop ringing, margin calls slam your desk, and the loss numbers glow red like a warning siren. Those bonds stamped AAA were suddenly toxic waste, and people stopped asking, how much can I make? They only asked one question, how do I get out? But Wall Street still had one very American belief. It's fine. If something big happens, someone will save us. And in March of 2008, Bear Stearns actually went down. The Fed had to jump in, drag it back from the cliff, and force a rescue deal. JP Morgan bought it for the price of a clearance sale. Wall Street exhaled. But that exact moment planted a dangerous thought into the entire system. See, someone will always catch us. And then, September 2008. This time, it wasn't a crack. It was the sound of an entire building collapsing. And then, boom, Lehman Brothers, a 158-year-old institution, collapsed. No bailout, no miracle, no heroic last-minute save, just a $600 billion crater carved into the center of Wall Street. And here's the cruelest twist. Lehman didn't die because it ran out of money. Lehman died because nobody wanted to touch it. Because once the fear hits, money isn't the problem. Trust is. And the moment Lehman fell, the entire world learned one brutal truth. If Lehman can die, anyone can die. So overnight, banks stopped lending to each other. Not because they ran out of cash, but because they ran out of faith. Every bank looked at the next one like they were watching someone cough up blood. You okay? Let me see your balance sheet. And then, actually, never mind. I don't want to catch whatever you have. And just like that, the credit market froze solid. Like someone yanked the power cord out of the global economy. The machine was running, and then it just shut off. And when credit freezes, everything freezes with it. A CEO calls the bank and says, I need a loan to make payroll this week. The bank says, sorry, no liquidity. The CEO pauses. What does that even mean? It means, we're scared too. Good luck, companies couldn't borrow. Payroll stopped. Layoffs began. And once layoffs began, people stopped paying mortgages, stopped paying credit cards, stopped buying anything at all. In just weeks, the economy looked like a body with its blood supply cut off, the heart still beating, while the hands and feet started going cold. Even investors couldn't escape. Funds got hit with massive withdrawals. Banks slammed their doors shut because nobody knew who was about to explode next. And suddenly, people weren't just losing money on paper anymore. They were losing real money. Retirement accounts evaporated. Pensions cracked. Savings disappeared. And panic spread faster than any virus. And then comes the part that makes this story truly terrifying. It didn't stay in America. Because American finance doesn't have borders, it has customers. Just days later, the fire jumped across the Atlantic. European banks that had been gorging on mortgage bonds started collapsing. Iceland, a country small enough to fit inside New York City, watched its entire banking system nearly implode. Markets around the world fell like dominoes. And that's when the world finally realized this wasn't a housing crisis anymore. This was a trust crisis. On a global scale, Wall Street was burning, but Main Street was the place that got turned into ash. Because regular people had no idea what a CDO or a CDS even was, and yet they still got stuck with the bill. And that was the deepest betrayal of 2008. Wall Street played casino, Main Street got the invoice. And when you see people standing outside banks not to deposit money, but to pull out everything they have, you know the game is over. But this was only the fall. The next part is the scariest question of all. Who's going to pay to save the system? And spoiler, it's not the guys who lit the match. Now the U.S. government was trapped in a nightmare dilemma. Save them, and you look corrupt. Don't save them, and the entire economy flatlines. One option sounds like justice. Let it burn. Let the banks fail. Let Wall Street pay. Let the gamblers finally lose their chips. It sounds satisfying. It sounds moral. It sounds like a movie where the villains get what they deserve. But here's the problem. You can't let a bank burn the way you let a store burn. Because a bank isn't just a company. It's the circulatory system of the economy. And if you cut off circulation, everything else dies with it. Companies can't borrow to pay workers. Factories can't borrow to buy materials. Stores can't borrow to restock shelves. And regular people can't borrow to buy cars, buy homes, or even survive into next month. A banking crisis doesn't stay a banking crisis for long. It becomes a life crisis. And if you let it spread another week, another 2 weeks, it stops being Wall Street panic. It becomes national paralysis. So in October of 2008, America chose the other option. The option everyone would hate. Pour money into the fire before it consumes the entire city. They gave it a polite name. The Troubled Asset Relief Program. But let's be honest. It was basically a $700 billion pillow for Wall Street to fall on. $700 billion. A number so big, if you hear it for the first time, you think someone accidentally sat on the keyboard and added an extra zero. And the irony is, Congress didn't approve it because they loved the banks. They approved it because the alternative was the entire system dying tonight. A lawmaker leans into the microphone and asks, like he's personally offended, $700 billion for what? And the answer comes back like it's the final line in a disaster movie. To shove it into smoking banks before they pull the whole economy down with them. Because this wasn't just a few greedy guys in suits. This was the plumbing of an entire country. And when the plumbing explodes, everybody gets drenched. And the bailout didn't stop with the banks. AIG, the insurance giant, had been selling credit default swaps like scratch-off tickets. They insured everything, even things they couldn't possibly afford to pay for. So when AIG started wobbling, Washington didn't see a company falling. They saw a grenade rolling under the table. Because if AIG went down, it wouldn't go down alone. It would yank down banks, funds, pensions, retirement accounts, anything tied to those insured bets. And at that point, you don't call it a crisis. You call it, we lost control. Then the dominoes kept falling. GM, Chrysler, American icons suddenly begging for oxygen. And again, the government pumped money in. Not because it wanted to. Because if those companies died, millions of people died financially with them. And the story stopped being about Wall Street. It became about dinner tables. And America watched the whole thing with two emotions at the exact same time. Fury. Because the people who lit the fire were getting rescued. Fear. Because if they didn't get rescued, the fire would eat everyone. And here's the part that really messes with you. The government bailout was only half the story. Because on the other side of the battlefield, the Federal Reserve was preparing something even more ridiculous. Ben Bernanke looked at the financial system like a doctor watching a patient turn blue. And he didn't reach for normal medicine. He reached for a flamethrower, a money cannon. Rates got slashed back near zero. Money became cheap again. But fear was still clogging the pipes. And when fear is still there, credit doesn't move. So the Fed pulled out the move that sounded like science fiction. Quantitative easing. And don't let the fancy name fool you. They created money out of thin air and used it to buy the toxic stuff nobody else dared to touch. It was like the market screaming the food is poisoned, and the Fed walks in like a calm psychopath and says, "Put it down, I'll eat all of it." And the weird part is, it worked. The system started breathing again. The panic eased. By March 2009, the stock market hit bottom and started crawling back up. Wall Street exhaled. Main Street didn't. Because bailout money flowed into bank balance sheets, not into the pockets of people who lost everything. And the aftermath looked like the end of the world. Unemployment hit 10%. About 8.7 million jobs vanished. Nearly 4 million Americans lost their homes. Millions more slid into foreclosure or default. And around $19 trillion in household wealth evaporated, like it never existed. So, in plain English, Wall Street popped champagne. Main Street stood in line for soup. And right at the moment Wall Street started recovering, a question sharp as a blade showed up in the minds of millions. Why did they get rescued, and we didn't? Because that question turned a financial crisis into something even more dangerous than money. A crisis of trust. And that anger didn't go away. It just sank under the surface, like an ember buried in ash, quiet, still, and burning, until 2011, when it finally broke through. New York City, Zuccotti Park, tents, drums, signs, and one sentence that summed up an entire generation's disgust. We are the 99%. But what really broke people wasn't the crash. It was what happened after. Almost no major Wall Street CEO went to jail. No handcuffs. No perp walk. Just bonuses coming back. And golden parachutes floating gently to the ground. Like nothing happened. So 2008 left behind a message everyone understood. But nobody wanted to say out loud. If you're big enough, you'll get rescued. And that might be the most dangerous seed of all. Because from that moment on, every time the market heats up again, every time a shiny new miracle story appears, people won't just ask, "Can I profit from this?" They'll ask something darker. If it collapses, will I get rescued too? And that's how bubbles inflate again. Not just with money, with illusion. So if you want to predict the next crisis, don't try to guess which industry it comes from. Watch for one sign, the sign that never fails. The moment society starts believing, this time is different, because chances are it's only different on the surface. Inside, it's the same poem. The system survives. Trust burns down first. And when trust dies, a bubble isn't a question of if. It's just a question of when.